Well, good morning all. Thank you for joining us. Today we'll be presenting our assessment of the regional outlook for this year. As some of you may know, this is the year of the rabbit, which is supposed to symbolize hope and prosperity. So we're hoping for a good year this year. Last year was the year of the tiger, which symbolized resilience. And indeed, the region, as you know, turned out very well. The growth was very robust, as we had expected. And even for China, which was struggling with COVID, I think the overall final outcome was pretty good, 3%, as I understand. But unfortunately for the whole region, because China's economy was dragged down by the recurring outbreak and its strict containment policy, it led to production disruption and weaker spending, and as a result, growth was weaker than what we had expected at the beginning of the year. We expect the authorities to gradually open up the economy this year over several months. However, the authorities have decided to move more swiftly and decisively than we expected. They have reclassified the virus as a mild disease and have removed almost all containment measures in the last several weeks. And the economy is now fully reopened. As a result, there's been a huge surge in infection in China, and people have ironically pulled back and stayed home instead of going out to spend. So China is going through a difficult period of transition from pandemic to endemic. I mean, we saw that last year, or in the ASEAN country itself. So this will take a few months, but we expect that by the second quarter of this year, the economy will be bouncing back again, as what happened with the ASEAN economy last year. Okay, I'd like to start with an update of our regional risk map. I think some of you are familiar with this risk map. We have identified 5 major risks. This is one less than last year. The color of the bubble basically represents how severe the impact would be if it materialized. And so, at the top of the bubble is the spike in energy prices. That used to be at the very top. We move it down to medium. And that's because energy prices have come off quite strongly, and also the global economy is expected to be quite weak this year. So but we still see that as an important risk because the war is still raging, and there's sanctions and retaliations, and that could lead to higher prices. The other factor is China. China, as I noted earlier, is expected to bounce back very strongly in the second half this year, and that could lead to a spike up in commodity prices, including energy prices. And if that happens, then some of the energy importers, commodity importers will be affected. The other risk that we have there is a slower than expected recovery in China. As I said, China is going through a transition. We still expect a relatively robust recovery this year of 5%. But it could be slower depending on whether the infection comes back, and if that happens, that could be a drag on the economy and could end up a bit lower than what we expect. The other risk that we have identified is a sharper slowdown in the US economy. At the moment, I think most people expect the US economy to have a soft landing because the labor market has been pretty strong and inflation has come off. So there's some expectation that the Fed may ease off, and that would, that's why the market has been rallying to some extent. On the other hand, if commodity prices spike up because of China and inflation, were to go back up again, the Fed may be forced to tighten policy again or to maintain the policy for much longer. There's also a view that once inflation gets to 4%, it's going to be much harder to bring it below 4%. And the Fed may have to tighten in order for that to happen. The other risk that we identify is the emergence of more virulent COVID-19. If that happens, then many countries will be forced to adopt stricter containment measures, and that's going to be bad for the economies. And finally, we have a bubble on the far right called heightened geopolitical tension. It's basically the tension between the US and China. At the moment, it's pretty heightened, but it can get worse. And if that happens, that could lead to geopolitical and geo-economic fragmentation. And I think that has been identified by many as a potential risk to the global economy. So let me move on. So very quickly, this is the chart on the COVID infection, and you can see that there have been several waves. Just when we expected things to calm down, we now have a massive wave here, and this is mostly in Japan, Korea, but we know also in China as well. We expect that each of these waves lasts for about 2 to 3 months to subside in the coming months. And already there are signs of in China that things are picking up. Mobility has apparently spike up again. This chart shows the external demand, the driver of growth. So you can see from here that the growth in the last for the region was driven very much by private consumption. That's the red bar here. And this has helped offset the weak export earning in the third quarter. And so the external demand is weakening because the global economy is weakening, particularly the US economy and the Europe, and that's a drag on growth. But fortunately, domestic demand has been very strong, and that has helped to drive growth. On the other hand, if you look on the right hand side, the manufacturing sector is beginning to turn more yellowish and orange. So there's been this in line with what our expectation that going forward, the headwinds are going to be much stronger, and manufacturing is going to be more affected than the other sectors. So they are beginning to turn orange, as you can see over here. On the export side, you can see the downward trend in export of goods particularly. The volume has held up, but the value has come off, and that to some extent reflect the decline in commodity prices as well. But also services export, are trending down, although they have held up much better than the goods exports. On the other side, you see tourism arrivals, and this has picked up actually quite strongly. As you know, many of the countries in the region are very dependent on tourism, and on a monthly basis, they have reached about 40% of pre-pandemic level, and we expect this to continue to spike up now with the reopening of China. Many of these countries depend on China for the tourism arrival, accounts for about 30% of the tourism arrival for many of these countries. So Thailand is a good example. They expect tourism to reach about 70-80% of the pre-pandemic level by this year. But most other countries are also, dependent on tourism. Malaysia, Cambodia, Laos, and even Singapore. So this will be a boost for the region, and it will help to offset to some extent the slowdown in the manufacturing sector. This chart shows leading indicator for US and Europe, as I mentioned earlier. The US is, the labor market is still relatively strong, but if you look at the PMI indicator, it's actually trending downwards. So the risk of a recession is still there. And if you look on the chart on the right side, the two bars here, the probability of a recession in US and Europe is very, very high, more than 80%. This chart shows that commodity prices have basically reverted back to pre-Ukraine war level. This is the marker for the outbreak of the war in Ukraine. And you can see that commodity prices spiked up at that time, but they have since reverted and fallen below this line here. So that's the one positive development, which is that inflation is also, because of the decline in commodity prices, inflation has also started to level off and come off. So this line is for the US, and you can see that inflation has peaked and is coming off. And for the region, this is the line for the whole ASEAN+3 region. But if you strip out Laos and Myanmar, you get a much lower level of inflation, and it's sort of leveling off and beginning to turn around. This chart shows the inflation for the region. The blue bar here is for the first 9 months of last year, And you can see that the level is much higher than the target inflation for most of the countries. So except for China, Vietnam, and inflation is much higher than the target inflation. And because of that, the central banks have been very proactive in tightening, normalizing their monetary policy. And this shows up on the chart on the right side where the rates, these are the policy rates that they begin to go up sometime towards the end of middle of last year, I would say. No, actually it's earlier than that. For some countries, it's even in 2021. In any case, you can see that the level is, some of them have already exceeded the pre-pandemic level, but most of them have reached or exceeded pre-pandemic level. So central banks here are very mindful of the need to anchor inflation expectation and the curve prevents inflation from becoming entrenched. And so because of that, they have been quite aggressive in tightening. But I think most of them have almost reached the end of the tightening cycle, and we expect them to begin to flatten off. This chart shows that markets have generally rallied across the region. The exchange rate depreciated very sharply, but then have started to appreciate a few months since November, I think. Japanese yen, you can see, went up to almost 150 at one point, but it's come off now. And similarly for all the other the currencies in all the other regions. So the pressure is off the exchange rate, which is a good thing. And the stock market have also rallied. You can see that it's beginning to spike up here in the last month or two. And some of this is also because of the reopening of China and the fact that the Chinese government has announced that they're going to ease off on the tech crackdown on the tech companies. On the right side, you see the bond market. Bond market have gone up. The rates have gone up, and they have sort of leveled off now. But what is interesting, if you look back, you find that bond interest rate have actually not exceeded the pre-pandemic level. So although they've gone up, they've basically leveled off at just about the or below pre-pandemic level. So we now come to our table on our forecast of growth for the region. So as I mentioned earlier, we revised the growth for the whole region down slightly from 3.7 to 3.3%. And most of this is because of the +3, as you can see from here. We revised it down from 3.3 to 2.6. And much of that is China, 3.8 to 3. We started off the year at about 5%, and it came down progressively during the year. Hong Kong, on the other hand, has been expected to register negative growth this year, contraction of 2.5%. And the other country, +2, Japan and Korea, slightly weaker. Japan especially, but Korea turns out to be a bit stronger. For the ASEAN country, on the other hand, we have revised the growth rate up to 5.6% from the October 5.3%. And we see that some countries in the region have very strong performance. For instance, Malaysia, we had expected 7.3. Now we revised it up to 8.4, probably one of the highest in the world. And similarly for Vietnam, it's going up from 7% to 8%. So another very strong performer, and the Philippines as well, 7.3. So the region has done very well overall. We had expected that early in the year because of the reopening of the economy, that most of the growth will be driven by domestic demand. And despite the headwind in the last quarter of the year, the growth has held up very well for the region. The issue is going forward with uncertainty and headwind, how the region will perform. So we have revised forecast growth of 4.8%, which is basically a normalization of growth for this year from the very high growth from last year. But if you look at the growth rate for individual countries, they're still relatively robust, basically a pre-pandemic trend growth. So now we are at, for Malaysia, for instance, from 8.4, we have revised it down to 4. which is closer to their potential growth rate. So we have done the same thing over here. And for China, we expect very strong rebound this year, 5.5%. Although I think some analysts are expecting even higher growth than 5. I just saw Goldman Sachs at 5.5%. So there is some uncertainty about how long this transition is going to last and how strongly the economy will rebound in the second half next year. But overall, the region should do quite well, and we expect 4.3% for the whole region. Okay, for inflation, as I mentioned, inflation is already trending down. We were at last year we ended up at 6.3% for the whole region, and we expect that to trend down to 4.5% this year. So the pressure is coming off inflation. It's beginning, but of course it varies from country to country. We have Laos at 11%, but that's because the exchange rate is still is quite weak. And similarly for Myanmar. But other than these two countries, I think inflation is relatively low to moderate across the whole region. So basically the key message is that the region, has done growth in the region is expected to weaken this year after a very strong growth last year. And because of the rising risk of recession in the US and Europe, the headwinds are pretty strong. Although, as I mentioned, inflation has come off, so we expect the Fed to ease off, after another maybe round of tightening. So that will provide some relief for the region. And the reopening of China is a very big positive shock to the region. It's going to provide a major offset to the external headwind coming from the US and Europe, and help to support growth, especially in the services sector and tourism. So overall, we expect growth to come out at 4.3 this year, compared to 3.3 last year, and inflation to moderate from 6.5% to 4.5% this year. Okay, let me stop here. Happy to take questions.
Thank you very much, Dr. Khor. So yeah, we've come to the point where you get to ask your questions, and I just remind you to please put them into the Q&A in the WebEx. I mean, this is a good opportunity for you to ask questions on the region, but also country-specific questions which might help whichever stories you're writing. Okay, we're going to start with a couple of questions that have come in already. I guess inevitably, Dr. Khor, there are questions about China, so maybe we'll go to those first. First one is from China Daily, and the question is, how may China's reopening impact ASEAN+3 regional growth? Which economies may be influenced most, and how?
Yes, China's reopening is extremely important for the whole region. We know that China is the biggest trading partner for many countries in the region, not just the region, but for many countries in Africa, in Latin America. And so the strong China would help to support the global economy because of the expected slowdown in the other countries. Many of the countries are linked to China, through many channels. China is the biggest importer of commodities, and some of the economies in the region are commodity exporters, in Malaysia, Indonesia, Brunei, and so they will benefit from a strong rebound in China. And they also import capital goods from advanced economy like Korea and Japan. So they will help to support the manufacturing sector to some extent. And China is closely plugged into the global regional supply chain. So there's a lot of trade in intermediate goods. So the fact that China is rebounding would help ensure that the production is not disrupted and remains strong. So we find, for instance, that a lot of countries export semiconductors to China for reprocessing, into phone and other electronic products. And the region in turn import a lot of intermediate goods from China. For instance, fabrics goes into garment industry in Cambodia and Vietnam. And China increasingly has also become the world's largest consumer market. Right? So it's also a consumer final product. Good example, of course, is tourism, where China is now the biggest market for tourism for many countries in the region, but also in terms of consumption of other, consumer products, manufacturing products. Another area where China is important for the region is investment. China has emerged as in the past, China used to be an investor in the natural resource industry, but now it's an investor in a whole range of industry, including manufacturing. And it's also, and many of countries in the region needs infrastructure. And again, here, I think China, has become a major investor in infrastructure. We just saw the completion of the Lao-China Railway in Laos, and the high-speed railway between Jakarta and Bandung as well. So countries in the region, especially Philippines and Indonesia, look towards China to help them fill the infrastructure gap that they need in order to sustain potential growth. Let me stop here. Yeah.
Thank you. Thanks, Dr. Khor. I mean, it's an interesting point. And also the follow, there's another question here from the Business Times, which I guess touches on the impact of China on the region and more globally. And the question is, the market seems to be split over whether 2023 will be a better year for Asia. Some, like Barclays, think China alone will not be able to stall the global slowdown. And what are your thoughts?
Yeah, that's a good question. As I think mentioned, there's a lot of uncertainty about going forward how China is going to perform, especially this year. So we have taken the optimistic view that China will rebound quite strongly in the second quarter onwards. But some people think that it might take longer, and I said there's some risk. It depends on how infectious in some sense the virus is. There could be recurrence of infection, just like what happened in Korea and Japan. In which case there will be a drag on growth on China. So because of that, and the fact that US and Europe are going to be relatively weak, it means that the region could turn out much bigger than what we are projecting now. But that's not our baseline view. Our baseline view is that the region will do much better this year, will continue to do well this year rather. And they will not grow as strong as last year, especially the ASEAN countries, because of the bounce back, because of high base. But they will certainly revert back to potential growth, which is quite robust. So our view is that this year will continue to be good for the region, especially now that China is bouncing back. It will also help to offset the headwind from coming from the US and Europe.
Okay, thank you very much, Dr. Khor. We're going to move now to the Philippines, and I know there's been quite a few questions which touch on the same topics, the outlook for the Philippines. So just at this, for example, this one from ABS-CBN News. Question is, can you tell us the outlook for the Philippine economy, as well as the headwinds and tailwinds that will be in play this year? And can you provide outlook on GDP, inflation, and BSP monetary policy decisions? Thank you.
Yeah, Philippines has had a very strong year last year. They grew, we expected growth came out to be 7.3%. Following, I think the year before it was, let me see, I've almost forgotten. It's 5.7. So during the course of the year, we were not very sure how well the economy will do, because the central bank was tightening policy. But as it turns out, the economy has turned out to be very, very resilient, and growth outperformed our expectation in third quarter. And because of that, we have revised up the growth rate from 6.9 to 7.3% this year, last year rather. And this year we expect growth to revert back to potential of around 6.2%. So this is still a very strong growth rate. So the economy overall is done well. Inflation is relatively high, but that's because unlike some of the countries, Philippines does not have any price subsidies, to contain inflation. So there's a straight pass-through from commodity prices, high food prices to inflation. And as a result, inflation's ratchet up very quickly. But I think the central bank has been very proactive. They have tightened policy, very aggressively last year, and because of that, now as you can see, the policy rate has already exceeded the pre-COVID level. So I think that's the right thing to do. Our recommendation had been that once the economy is recovering very strongly, momentum and growth is entrenched, then the central bank should focus on inflation and control inflation, and that I think is what BSP has been doing. I know that the governor has mentioned that there could be another 50 basis point increase before they end the tightening cycle, and the plan is also to reduce the reserve requirement ratio by 100 basis point. But they only do that once they see evidence that inflation has come off, which I think is again the right thing to do. Yeah. Let me stop here.
Thank you, Dr. Khor. I see there's some more questions coming in, Cambodia, Singapore, and also Malaysia. So I'm going to go to a question on Cambodia first, but then there's also questions that just come in on the Malaysian economic outlook. First on Cambodia, and this is from the Khmer Times. Which sectors are likely to perform well in Cambodia in 2023? What are the major challenges being faced by Cambodia's economy?
Yeah, Cambodia, as we all know, is a major garment exporter. And unfortunately, a lot of the export goes to US and Europe. And because of the slowdown in those two economies, the garment industry will take a hit. It's going to be weaker than before. But fortunately now, because of the recovery in China, the tourism sector will be, get a big boost. So we expect tourism to recover rapidly in Cambodia this year, and that will help to offset the slowdown in the manufacturing garment industry. But other manufacturing have started to pick up. There's been more investment now in other types of manufacturing products away from garment. Bicycles and shoes and other products, and also there's been the housing industry, which was depressed because of COVID, is coming back again. So overall, we are quite optimistic about the growth in Cambodia. We are projecting growth of 5.4% this year, up from 5% last year.
Okay, thank you very much, Dr. Khor. And as mentioned, there's a question after coming in on Malaysia. So it's what is the economic outlook on Malaysia? What are the challenges, and what is the inflation rate target for Malaysia?
Yeah, Malaysia, as I mentioned, could have 8.4% growth last year, which is one of the highest in the world. And although we expect growth to come off to 4%, it's coming off from a very high base. And so overall, I think the authorities have done a good job in managing the economy through the shocks in the last 3 years. And the economy, we expect to now revert back to basically trend growth. Of course, because of the stimulus packages and all that, the fiscal space has shrunk. But now that the economy has recovered, there's less need for fiscal stimulus. On the other hand, we know that there are some sectors in the economy which are still lagging behind, and because of inflation has gone up, many of the poor households are also struggling with high inflation. So we actually support the government's plan to provide targeted support for those vulnerable groups in order to help them cope with the high cost of living.
Okay, thank you very much, Dr. Khor. Next, we're going to turn to Singapore, and this is from Zabao. Apologies for my Chinese pronunciation there. I hope I got that somewhere near correct. The question is, could you share some view on the Singapore economic outlook going forward and high inflation rate, rapid monetary tightening and global recession fear?
Yeah, Singapore was one of the first to rebound from the COVID pandemic. they had a very strong rebound back in 2020 after the initial hit. And in 2021, they had a 7.6%. Yeah. So they were the first to recover back to pre-pandemic level and trend upward level. And last year, growth weakened somewhat to 3%, which is still stronger than what we expected. So the economy is fundamentally strong because they provided a lot of fiscal support when the pandemic hit to support the economy, to avoid the scarring on the economy. And even though the economy was locked down, some sectors of the economy performed very strongly, manufacturing, services, and all that. Unfortunately, the labor market is very tight now because not all the foreign workers have returned, and because of that, you see pressure in the labor market. And also because of the shutdown, there's been a shortage of supply of housing residents, and so housing prices have been going up very strongly. And because of Singapore is a major importer of food, inflation has also gone up because of high food prices and high fuel prices. So Singapore has been hit quite badly in terms of the inflation because of it's dependent on food, on imports, and also because of the lockdown in the last few years, which constrained the supply of major items. But we expect inflation to come off this year, and already there are signs that inflation has come off. I think the most recent data on headline inflation from 4.5 to 3.5, about that. And I mean, it'll be a bit sticky compared to the other economies because they've been hit on multiple fronts in terms of the price increase. But inflation is very well anchored in Singapore, and we know that MAS is very proactive, and they will do whatever it takes in order to make sure that inflation come off. But and at the same time, because of the high inflation, the government has a lot of fiscal space, and they are providing support for the vulnerable groups. So they have announced a $300 voucher for the population to help them tide over the high cost of living.
Okay, Dr. Khor, thank you very much. Just returning now to a more specific question on the Philippines, also from ABS-CBN News. The question is, we also want to ask AMRO about its outlook on the Philippines' infrastructure challenges. I suppose as highlighted by the New Year's Day shutdown of Philippine airspace. Thank you.
Yeah, infrastructure is a major weakness for the Philippines. And so under the previous administration, they had a very ambitious infrastructure program, build, to address that. And this administration have built on that. So now it's built better and more, something like that. So fortunately, as I mentioned earlier, I think there's financing available now, especially with China's Belt and Road program. And as we know, the president just made a trip to China to encourage more investment in infrastructure and also in other areas as well. But I think Philippines needs to address the infrastructure problem in order to be able to sustain the growth. We know that for instance, even in tourism, there's a lot of potential because but they need infrastructure in order to be able to get the tourists to come to the Philippines. So that's one area where I think they're focusing on to develop the tourism industry and build more infrastructure as well. So let me stop here.
Thank you, Dr. Khor. Okay, so just to return to some questions on China, I suppose inevitably there's quite a lot of interest. So I'm going to go back to a question which is from Angela Tan again at the Business Times. Many economists expect China to deploy more fiscal measures to pull the economy out of the rut. Do you think this is possible given China's fiscal debt and financial constraints facing even local governments. What then can China do?
China's overall debt level is high, but it's mostly in the corporate sector. The government's debt level is actually quite moderate by international standard. So if you compare China's government debt with other emerging markets and advanced economy, it's quite low or moderate. It's in the region of about 40+%, I believe. So there is fiscal space which they can use to support the economy if they need to. But and they did use it last year when the economy was struggling with the COVID. But this year we expect a strong rebound in the economy. So there's really less need for a fiscal stimulus this year. On the other hand, there are some sectors in the economy which are lagging behind. SME sectors, hospitality, retail, and all that. So those sectors may need some targeted support in order to help them to recover. And also the real estate sector, as we know, the real estate sector was a drag on the economy last 2 years. But the authorities have announced that they're going to ease up on the regulatory credit policy on the real estate, on the big property companies. So we expect the real estate sector to bottom out this year and begin to rebound again. But they may need some support, targeted support from the government. Although much of this, I think, is going to be regulatory rather than actual financial support. So otherwise, we think it's time for the government to consolidate its fiscal position rather than continue to provide stimulus support to the economy.
Thank you, Dr. Khor. I'm just looking here. There is a question from The Edge. And the question is, you said more virulent COVID-19 might spike inflation. Would central banks jump into a cycle of increased interest rate hikes again, despite reaching the end of tightening cycle?
Sorry, which country are we talking about?
Because this is from The Edge media. So
asking about,
you said that the more virulent COVID-19 might spike inflation.
Oh.
Would central banks jump into a cycle of increased interest rate hikes again, despite reaching the end of a tightening cycle?
Okay. Well, if there's an outbreak of the virus, a virulent virus, then I think it's quite obvious that authorities will have to shut down again or adopt stricter containment measures to prevent the virus from spreading. But I think we'll try to be as targeted as possible. But there's no doubt that it's going to be a lot more damaging compared to the current virus, Omicron. So there'll be a need for more fiscal support at least. On the monetary policy side, it depends, I suppose, on the inflation. If the inflation continues to come off, which we expect to happen, especially if there's an outbreak of the virulent virus, then there'll be less need we expect inflation to come down as well. In which case, then the central bank may have to ease its policy in order to provide a bit more support. But we think most of the support would have to come from the fiscal side rather than from monetary policy. Yeah.
Okay, thank you very much, Dr. Khor. I'm just looking at the time. I think we've time for one more question, which is there's one here from UK Media Group. So what do you? It's a trade-related question, a trade growth question. What do you think of the favourable conditions and obstacles to trade growth in 2023? Will demand be weaker this year than last?
For the region, I think the main obstacle to trade, as we all know, is this tension between the US and China, and the sanctions imposed on trade by the US and all that. Otherwise, we know that during the pandemic there was disruption to trade, and a lot of countries, begin to try to build resilience into the global value chain by inshoring or friendshoring the supply. But that's basically a reconfiguration of the supply chain. It will not affect the global trade, except that you contribute to greater resilience, and you will reconfigured in terms of the production of the product, in different countries. So that I don't think will be a very serious threat to global trade. So we think that at the moment the main constraint to trade really is macro performance. If the US and Europe would weaken, go into recession, that would be a big shock on the demand side to trade. But otherwise, but because of China emerging and bouncing back, that will help to support trade. So I think the bulk of global trade will not be very much affected by what's happening in terms of this tension between the US and China on the tax products, as well as the sanctions imposed, the tariff imposed on China by the US.
Okay, thanks a lot. Actually, I see we've just got a few more minutes left, and there's maybe one more question we can get to on China, which is from China Daily. It's on China's consumption recovery. How do you see the prospect of China's consumption recovery? Is providing cash subsidies or consumption vouchers a feasible tool for China to expand consumption in the light of other economies' experiences? If not, what is your policy advice to promote consumer spending?
Yeah. No, I think consumption vouchers has been used in the region to support especially the vulnerable group and the poor because of the high inflation. And it can also be used in China. But as I mentioned, we expect China to open up and demand and consumption to rebound this year. And inflation in China has been pretty low, So inflation has not been an issue in China, and the cost of living has not gone up. So there's really no reason for China to resort to cash voucher. But if there is a need because of the impact of loss of employment, as what happened in the case of Hong Kong, then certainly we would recommend the use of cash voucher to support the vulnerable groups. Yeah.
Okay, thank you, Dr. Khor. Okay, ladies and gentlemen, we've run out of time. We've come to the end of today's press briefing. I would like to thank you all for attending. Just to remind you, if you haven't seen it already, on the website you can download the press release and the update of the ARO report, as well as Dr. Khor's presentation that he gave earlier. Our next briefing will be for the ARO report for 2023, so stay tuned for that. We will let you know well in advance when that's going to occur. So thank you very much for joining us, and we'll speak to you again soon. Thank you.
Thank you.